Are investors who chase high-risk assets overlooking the benefits of investing in relative liquidity? Roger Ibbotson is a finance professor at Yale University. He is also chief investment officer at Zebra Capital Management. Roger, welcome to the program. Good to have you.
Great to be here.
Explain this whole idea of relative liquidity. We were just talking during the break about this whole idea that people really want, or seem to want, very liquid investments. They want to be able to sell them or buy them at a moment's notice. And you say pay attention to that whole concept of liquidity.
Yeah, well, everybody knows that we would pay a lot for liquidity. But the surprising thing is people pay a lot for just a little bit more liquidity. They never seem to feel they have enough liquidity. But people don't need perfect liquidity. They could have just a little less liquidity. And there's a liquidity premium. You get an extra return by taking on a little less liquidity. So just like risk and return, there's a risk premium. With liquidity in return, there's a liquidity premium.
Now, is there a liquidity premium based not necessarily just on asset class, whether it's real estate, because we know that that can be very illiquid, but also among different types of, let's say, equities? Are there different levels of liquidity for stocks?
Yes, there's a continuum here. And it goes across the board. So you can go all the way to real estate or private equity or distressed debt type of things. These type of securities may be very illiquid, but you can also just go partway there and pick up quite a bit of the liquidity premium.
Talk about some of the companies that you focus on to sort of illustrate this whole idea. For example, Snap-on is one of the companies that you have invested in. Why is that illiquid in or less liquid, I should say?
Yeah, it actually has very low trading volume. Snap-on is a company that makes professional type tools. So your carpenter might know about Snap-on, but your carpenter is probably not a big investor. So whereas the consumers don't know about a stock like that. So these are the forgotten stocks. There's other stocks, but they're the stocks that nobody would have heard of. The kinds of stocks that you haven't heard of are the likely to be the stocks in our portfolio.
But having said that, when people talk about liquidity, they're always worried about maybe moving the market when they make an investment in these things. I mean, is that something to be concerned about?
You could move the market a little bit, but you have to have big scale. The market we're talking about publicly traded securities, so unless you're dealing in billions of dollars, you're not going to be moving the market in most of these stocks. We're actually talking about in the U.S. the top 2,000 stocks, and those stocks have a lot of liquidity, but some of them have a lot less than others.
And how do you go about sort of identifying these? Is it just based on trading patterns, or is it also based on the sort of job that the company performs in the marketplace? Like, as you said, Snap-on tools.
Well, we look at we want them to have strong fundamentals. So we're trying to buy strong fundamentals in less liquid form, but they're still publicly traded. So we do look at trading volume. We look at turnover rates. We look at things like this that actually tell you how much these things are traded. And we want the ones that aren't traded as much.
What about Archer Daniels Midland, ADM? That was also one of the stocks that you were focused on. How does that become less liquid?
Well, actually, that's a stock that has varied a lot over time in its liquidity. It was a totally forgotten stock in the early 2000s. And then the commodity boom came in 2007 and 2008, and the liquidity of that stock soared. The trading volume went up 10 times, and the price went up. But in that context, the price went up actually as the liquidity started to go up. But then as the liquidity was high, this stock started to drop. And now that the liquidity is starting to drop in the stock, it's still quite liquid. But now that people are forgetting about it again, that's what makes it a good buy again.
Would stocks that have concentrated ownership positions, would that also qualify as something that is less liquid? Let's say if management owns a huge chunk of the equity?
Those are a good prototype of a stock those are stocks that are less liquid. And actually, we're launching things in Zebra Capital is launching funds in Japan, and the currency companies have a lot of cross-ownership. Those companies tend to be long positions in our portfolio.
Now, that can't be the only thing that you're going to measure in terms of the liquidity. You say you like to look at the company's fundamentals as well. In the case of, let's say, Snap-on, recent report saying that the European business still pretty sluggish, people not opting for these storage bins, these storage profiles for their various tools. How long would you stay with an investment before you kind of say, okay, the fundamentals overweigh the liquidity issues?
Well, you're actually looking at both the fundamentals fundamentals, things like the earnings and the trading volume, and you're looking at one relative to the other. And when the trading volume is a lot higher than the earnings, you want to be short a stock like that. But when the fundamentals are stronger than the trading volume, you want to be long a stock like that. So you don't need to be great fundamentals, but you want stocks that have enough fundamentals that sort of exceed their trading volume.
Last question for you, risk premiums. How do you judge risk premiums in a market when you're looking for things that are less liquid?
Well, I think of them as two separate things, first of all. I've studied all my life risk premiums, and that's why I'm so excited now to be talking about liquidity premiums. I think of risk premiums are the thing that everybody's talked about for 30, 40, 50 years, and I was one of the first ones to really talk about equity risk premiums and so forth. But it turns out that liquidity premiums has had very little talk, especially in the equity market. People talk about it in real estate or in debt, but they don't talk about it in equity. This is the forgotten area. So I don't really want to talk about risk premiums because I want to talk about liquidity. That's the forgotten area in the equity markets.
All right, so focus on liquidity for the time being. At least that's a sort of a novel approach. Thank you very much, Roger Ibbotson, finance professor at Yale University, also a chief investment officer, Zebra Capital Management.